What is up, bag chasers, and welcome back to the Bag Breakdown. It's your host, The Star, and today, we are diving deep into a company that is, and I'm not exaggerating here, the literal plumbing of the entire global financial system. We're talking about the Bank of New York Mellon, or as the cool kids call them, BNY. Now, they just dropped a massive earnings report that sent some seriously confusing signals to the market, so you already know we have to break it all the way down. Let's get into the weeds, let's chase this bag, and let's see if it's really worth securing. Okay, so look, when you hear 240-year-old bank, what pops into your head? You're probably picturing something straight out of a history book, right? Like cobwebs, dusty old ledgers, maybe some dude with a quill pen. You're thinking slow, you're thinking outdated, and let's be real, you're thinking kind of boring. But what if I told you this ancient institution is in the middle of a serious glow-up? And I mean a full-on transformation. It's shedding its old skin, getting rid of the dusty vibes, and straight up rebranding as a technology-led financial platforms company. Yeah, you heard me. A FinTech. Now that's a super bold claim for a bank that's been around since the 1700s, but they are putting their money where their mouth is, and we are about to check the receipts to see if this hype is real.
Before we even touch the income statement, I need everyone to just pause and really look at this number for a second. $59.3 trillion. Let's try to wrap our heads around that because it's almost impossible. The entire GDP of the United States, everything made and sold in the country in a year, is around $27 trillion. This number is more than double that. This is the value of assets under custody and/or administration at BNY. So what does that mean? It means they are the trusted custodian, the digital vault, for a staggering amount of the world's wealth. They don't own it, but they process it, they track it, they keep it safe. They are the bedrock, the foundation that the entire global market is built on. So when a company this massive decides to innovate, it's not just a big deal for them, it sends ripples absolutely everywhere.
All right, so the record-breaking, absolutely insane numbers we're about to get into, they didn't just fall out of the sky. This was not a lucky quarter. This wasn't just them riding a hot market. No. This was the direct result of a calculated, multi-year master plan. They basically took a long, hard look in the mirror, saw this legacy institution, and decided to gut renovate the entire business from the inside out. This wasn't just a fresh coat of paint. This was a blueprint for a complete identity change. The glow-up was very, very real.
And you can see right here, this wasn't some overnight success story. It was a deliberate 3-year mission. It all kicked off back in 2023 with the official launch of their transformation initiative. Then, 2024 was the grind. That was the deep execution phase, where all the hard work was happening behind the scenes, rebuilding systems, hiring tech talent, changing the culture. And 2025, the year we're analyzing today, that was basically the victory lap. That was the successful completion of phase 1. The whole entire point of this was to pivot from being a traditional, slow-growth, kind of boring bank to becoming a high-margin, tech-forward platform that operates with the efficiency of a software company. This timeline right here shows you just how serious and committed they were to that vision.
All right, Star, that's a nice story. Transformation, glow-up, I get it. But show us the receipts. You know it. That's exactly right. You know how we do it here on the Bag Breakdown. Talk is cheap. It's time to verify this whole narrative with the cold, hard numbers. Let's pull up the primary source document, the income statement, and see if this so-called glow-up actually paid off on the bottom line.
Okay, bag chasers, pause the explainer if you need to, because this slide right here is the absolute heart of the story. Let's break this thing down line by line. First, look at that top line, total revenue. They cleared $21.1 billion for the first time in their 240-year history. That's the total cash coming in the door. Now, let's scroll down to the bottom line, net income. This is the profit. This is what they actually get to keep after paying for all the employees, the rent, the tech, everything. A massive $5.3 billion, which is up a huge 22% from the year before. But the most crucial number for investors, the one that really moves the stock, is that last line, earnings per share, or EPS. It hit $7.40. This number tells you how much profit the company made for each single share of its stock, and that number is what Wall Street lives and dies by.
And just to really let that top-line growth sink in, check out this bar chart. From about $18.6 billion to $20.1 million. That's an 8% year-over-year jump in revenue. Now, I know what you might be thinking. 8%? That might not sound like a lot if you're talking about some small startup that's doubling every year. But for a 240-year-old financial titan, that is a monumental move. This is like a massive cruise ship suddenly accelerating like a speedboat. Legacy banks are supposed to be slow, steady, 1% to 2% growers. An 8% pop in revenue is proof positive that their strategy to find new growth engines is absolutely positively working.
Now this is where it gets really crazy. That 8% revenue growth we just saw, It didn't just translate to an 8% profit growth. Oh no, it led to a 28% explosion in earnings per share. 28%. That is an insane, almost unbelievable level of growth for a company of this scale. Let me break it down. This means that for every single share of BNY stock you owned, they generated 28% more pure profit than they did the year before. This is the number that should have had investors popping champagne. It's the ultimate proof that the whole transformation thing wasn't just talk.
But here's the plot twist. On the very same day they announced these record-breaking, analyst estimate-beating numbers, the stock actually dipped. It fell 1.48% in pre-market trading. Wait, what? That makes absolutely no sense. Exactly, what gives? The numbers are fire, the strategy is clearly working, so why the cold shoulder from the market? This is the kind of puzzle we love to solve here, and to understand it, we need to understand the single most important concept in their entire earnings report.
Okay, hold on, Star. On the earnings call, the CEO kept dropping this term operating leverage. Can you break that down for us? What does that actually mean in plain English? Bet, great question. Think of it like this. You're running a lemonade stand. Let's say you figure out a way to sell 10% more lemonade this year, but at the same time, you found a cheaper supplier, so your costs for lemons and sugar only go up by 3%. That extra 7% margin? That's your operating leverage. It's a fancy term that just means your revenue is growing way faster than your expenses. It proves you're getting more efficient, and every new dollar you make is more profitable than the last one. It is the #1 sign of a healthy, scalable business model.
And BNY is absolutely killing the game here. Just look at these numbers. For the full year, their revenue grew 8%, while they kept expense growth locked down at just 3%. That 5% gap is the magic. In finance speak, that generated 507 basis points of positive operating leverage. Don't let the term scare you. It's just a fancy way of measuring that efficiency gap. 100 basis points is just 1%, so that's a gap of over 5%. And in the fourth quarter, they went even harder. But the simplest way to say it is right there at the bottom of the slide. The bag is going faster than it costs to carry it. This right here, this is the engine that turned 8% revenue growth into that mind-blowing 28% EPS growth. This is the core of their entire transformation story.
So, okay, let's recap. They're making record profits, and they're doing it more efficiently than ever before. That's amazing for the company's health, but what does it mean for the shareholders? What about for us, the bag chasers? Well, this is where the story gets even better. They are not just hoarding this mountain of cash on their balance sheet, they are giving it back to the owners of the company, the shareholders. And they're doing it in a massive, massive way.
Just check out this donut chart. Of the $5.3 billion in net income they generated in 2025, they returned $5 billion of it directly to shareholders. That is a 94% payout ratio. No cap, that is one of the most shareholder-friendly moves you will ever see from a company of this size. Most companies reinvest a huge chunk of their profits back into the business. BNY is taking almost every single dollar of profit and handing it straight back to the owners. So how are they doing it? They have two main weapons in their arsenal.
First up, dividends. This is the most direct way. They hiked their quarterly dividend by 13%, up to 53 cents per share. If you own the stock, that's a direct cash payment deposited right into your brokerage account every 3 months just for holding on. It's a beautiful thing. Second, and this is the big one, share buybacks. They bought back $1 billion worth of their own stock in the fourth quarter alone. Now, why do this? By taking their own shares off the market, they reduce the total number of shares out there. This makes your slice of the company pie bigger, which automatically juices that all-important earnings per share number. It's a powerful two-pronged attack to maximize shareholder value.
Okay, so the main business is firing on all cylinders. We've got record revenue, insane profitability through operating leverage, and massive capital returns. That's the A side of the record, right? The big hit single that everyone knows? But what really gets me hyped about BNY's future is what's happening on the B side. It's time to look inside the side pockets, the smaller, future-facing bets where the real long-term alpha is hiding. This is where BNY stops looking like a 240-year-old bank and starts looking like a straight-up Silicon Valley tech company.
Remember that awesome operating leverage we just talked about? This slide right here shows you exactly how they're pulling it off. This isn't just corporate buzzword bingo. They have the receipts. They have 160 enterprise AI solutions already in production, including a big platform they call Eliza. They've deployed 134 digital employees. You can think of them as software bots that are automating all the boring, repetitive workflows 24/7. And the result? Just look at this. They generated roughly $550 million in efficiency savings from these initiatives. And, even more impressive, for some of their core operations, they cut the average cost per unit by 24%.
This is how you widen that gap between revenue and expenses. It's pure, tech-driven efficiency at work.
And this isn't some side project just to cut a few costs. This is central to their entire thesis for the future. On their earnings call, leadership said their goal is to, and I'm quoting this directly, unlock capacity using AI, and in so doing, serve our clients in new and better ways, enabling the global financial markets and infrastructure of the future. You see, they see AI not just as a cost-cutting tool, but as the actual engine that will power the next generation of financial services. This is their long-term vision, and they're not shy about it.
But the tech play here is so much bigger than just AI. Artificial intelligence is just one component, one piece of a much larger project. They are fundamentally re-architecting the entire company. They are rebuilding the core engine from the ground up to be a fully integrated platform-based business. Let's see what that really means for phase 2 of their transformation.
Okay, here's where it gets really, really spicy. Check out that last bullet point. Advanced Markets with Distributed Ledger Technology, DLT. For anyone who doesn't know, DLT is the secure, shared, decentralized database technology that powers things like blockchain and crypto. Let me just repeat that. A 240-year-old bank, the custodian of global finance, is explicitly stating that its future involves building on DLT. This is them planting a massive flag in the future of finance, a future built on tokenized assets and digital currency. This is not a defensive move, it's an offensive one. They're signaling that they plan to be a central player in how assets are moved and traded in the decades to come. This is where the real, explosive, long-term growth could come from.
So, 2025 was a record year that marked the successful end of phase 1 of their transformation. And they're teasing some seriously futuristic stuff with AI and DLT for phase 2. But what does the immediate future hold? What can we actually expect in the next 12 months? Let's check out the official playbook they gave to investors for 2026.
Here's the guidance, straight from the source. They're forecasting about 5% revenue growth. Now look at the expense line right below it, 3 to 4% growth. You see that gap again? That's them promising another year of positive operating leverage, targeting over 100 basis points, which is another 1% of efficiency gains. And their medium-term goal is to hit a 38% pre-tax margin, which means for every single dollar of revenue they bring in, they want 38 cents to be pure profit before taxes. The playbook for 2026 is simple. It's a disciplined repeat of 2025. Grow smart, stay lean, and let that tech-driven efficiency work its magic on the bottom line.
All right, bag chasers, we've done the work. We've broken down the transformation narrative, we've verified the receipts in the income statement, we've explored the incredible power of operating leverage, we've peeked inside the futuristic side pockets with AI and DLT, and we've seen the playbook for next year. We have all the pieces of the puzzle laid out in front of us, so it's time to put them all together and make the final call. Is BNY a bag we secure, or is it one we drop?
Let's lay it all out one last time. The bull case. The argument for securing this bag is powerful. You have record-breaking 2025 financials across the board. Check. You have the powerful engine of positive operating leverage, proving the business model is getting more and more scalable. Check. A massive, almost unheard of 94% payout ratio sending cash right back to your pocket. Check. Proven, concrete gains from their AI initiatives, not just hype. And a clear, disciplined growth plan for 2026. Now, on the other side, the bear case. Why would you drop it? Well, the stock's weird dip on good news could signal that the broader market just isn't buying the story yet. As a major bank, they're always exposed to big-picture economic and regulatory risks, like what happens if interest rates go crazy. Competition from both old banks and new fintechs is absolutely fierce. And there's always execution risk. Can they actually pull off these ambitious DLT plans without a major stumble? It's a huge technical challenge. After breaking down all the data, my verdict is in. For me, BNY is a definite secure, and here's exactly why. The market's weird, one-day reaction to the earnings seems like a short-sighted head fake that completely ignores the bigger picture. The underlying fundamentals here are just too strong to ignore. This is not your grandpa's bank anymore. They have successfully executed a massive transformation, turning themselves into a more efficient, more profitable, and way more tech-forward company. They are generating record profits, they have a clear plan for the future that fully embraces AI and DLT, and most importantly for us, they are rewarding shareholders with an absolutely incredible 94% payout ratio. They're not just making the bag bigger, they're literally handing it right back to you. So the real question isn't whether BNY has transformed, but when the rest of the market will finally wake up and realize it. That's all for this breakdown, bag chasers. Stay sharp and keep chasing. Peace.